44,000 construction jobs were lost in July. And what is concerning to me is that it's July, the middle of summer. These are the biggest and best months to get productivity in the construction sector. And over the last 3 months alone, 4% of all construction jobs were lost. We're going to talk about this and housing and your questions on episode 143 of the Wise Old Owl Show. Thanks for tuning in. If you're a first-time viewer, please click the subscribe or follow button and send me a DM if you have any questions. Now, this is a concern because we're also seeing a huge reduction in building permits. Okay, they're almost at a decade low. And we haven't seen this many construction jobs lost since the great financial crisis and back in the early 90s when there was a significant correction. So I'm really concerned about this. I think we're seeing more and more industries under pressure. Alberta is really booming. It's actually made up for a lot of these lost jobs. When you drill down in Ontario, this is a huge concern, very huge concern. And I really believe this is going to be damning into the future when we could definitely see a supply crisis when this population starts wanting to get more homes. It's really becoming a problem. We're starting to see homelessness across this country. I was downtown taking my dad to St. Mike's for some appointments, and the amount of tents in the parks downtown is just unbelievable. And it's a concern. And we are in crisis mode, and these governments at all levels have to figure it out. We're getting into the fall months soon. We will get into the cold season. And where are you going to put these people? We got a mayor in Toronto, the largest city in Canada, asking people to take refugees in their home. It's not going to work, folks. As immigration pours in, the majority land in Ontario. And to put things into perspective, every 2 years, the amount of immigrants that come into Canada, come into Ontario, is the size of Mississauga, and we're building homes for the equivalent of Cornwall. So just wrap your head around that. We have to cut the red tape. Mistakes are going to be made, but we're trying to build homes. We need them because you can't house them in a park. Can't house people in tents and in a park. It's not going to work in Canada. Okay, it might be able to be done in the South in the Caribbean, but not here. The bond market, I think, has started to react to those job losses in construction. Okay, because the bond market's come down a little bit since last week. Last week we peaked at over 4.03. It's come back down to 3.85, almost 20 basis points. And that's a good sign because it is an indication where the bond players think rates are headed. And it looks like with those job losses in the construction sector, and we're starting to see some softening in real estate and unemployment starting to creep up a little bit, we may be at the end of the rate hike cycle. So I really think that we're starting to get to the end of the Bank of Canada's rate increases. I hope I'm right. You know, we did indicate that in the past few weeks that we could see a further hike in September. If the unemployment numbers start creeping up and we start seeing more and more companies lay people off, like the financial institutions are already starting to lay people off. They're doing it quietly, but they are doing it. 10 people here, 20 people there. It's not in the hundreds, but they're doing it slowly, and it is representing hundreds of layoffs in the financial sector. The next thing I want to talk about is this unbelievable flocking of young Canadians to the new First Home Savings Account. And the new First Home Savings Account was a product that was launched in the 2022 budget. And it was designed to help people save for a down payment. And the product, according to Royal Bank and National Bank, have shown a significant success since its launch in about April. They said tens of thousands of people took advantage of the product. 76% of the people that opened up the account were between the ages of 25 and 44, which were really interesting. and 26% of them contributed the maximum, and just over a quarter of them are contributing on a regular basis. Now, the account itself has an annual cap of $8,000 to a maximum of $40,000, and if you don't use the full $8,000 in the first year, you could carry it over into the next year. So you could carry over unused amounts into the following years. It has similar attributes to an RSP and a tax-free savings account. What it allows people to do is any contribution made to this first home savings account is tax deductible in the year it's made, and anything earned in it is tax-free. So it's got the benefits of both the RSP and the tax-free savings account. So you get a tax deductibility of the contribution. So if you're in a tax bracket of, let's say, 40%, and you put in $8,000, you'll get a tax refund of $3,200, 40% of the contribution. And you're able to have tax-free earnings within it that you don't have to pay taxes on. What's interesting is although the program just launched in April, 5% of the people that have set up the account have withdrawn funds to buy a house and put towards their down payment, which is really interesting because unlike the RSP home buyer program, where funds have to be in it for at least 90 days before it could be redeemed, the first home savings account doesn't have that restriction. So it appears that a lot of people made the contribution this year and withdrew it, took advantage of the tax deductibility against their income, got a little refund, used the same funds to purchase their home, and maybe offset the tax refund against legal costs, land transfer taxes, or whatever. I think it's a really interesting tool, and another aspect to the home buying process that could give young people an advantage. We're going to keep an eye on the inflation number as well to try to see where everything's heading. But very concerning about those construction jobs. I think that could be the catalyst of the bank for the Bank of Canada to say, okay, I think we're doing what we need to get done, and it's slowly taking shape with the data numbers. With that being said, let's buckle up, tighten the chin straps, and let's get right into these questions. Can you explain how HELOCs are changing? I got a letter from CIBC this week. Last year, OSFI came out with some stringent rules for HELOCs. HELOCs mean home equity line of credit. And they were really concerned about people overusing these facilities to access cash. What OSFI has said is they want to cap that at 65%. So if you have a line of credit component beyond the 65% threshold, banks are going to be notifying you as of October 31st when everything takes effect, which happens to be the end of the last fiscal year for the banks, okay? And they all report on October 31st. Traditionally, you can get a HELOC, these type of products, up to 80% of the property's value. And you can have a mortgage component as well as a line of credit component. There used to be a cap to 65% of the line of credit portion, and then you could have a mortgage of the additional 15%. But as the mortgage was paid off, your line of credit balance would increase. So there are some folks out there that have HELOCs up to 80% of the appraised value at the time they took out the mortgage. Effective November 1, you may in fact be getting letters to convert the portion above 65% to a mortgage. So you have principal payment reductions to that 65% threshold, and then you'll get back into that line of credit product. Don't panic. If you do need some help in that regard, give us a call. We'll be happy to walk you through the details of the letter, how to plan for it, how to strategize, and how to get through it. If you currently hold a variable rate mortgage, what should you do? This is a very common question we're getting from a load of people calling in, DMing, and emailing. What we should always preface is you always want to know how long you have to commit to the lender that your variable is with. Usually when you take out a 5-year variable, you're committed to that lender for 5 years. If you are 2 years into your variable and you have 3 years left, traditionally the lender wants you to lock into a fixed rate of 3 years or greater to make sure that your commitment period is met, which is the 5 years. If you are 3 years into your variable, you could opt for a 2-year fixed, 3, 4, and 5. I want to know what rates they're offering so we can make an assessment of what term you should lock into before overcommitting to just a standard 5-year. Being at the tail end of the rate hikes, we could see some sunshine on rates coming back down a little bit, not back to where we used to be. We'll never see those rates again. At least I won't see them in my lifetime. But they will start shedding down at some point in time in the next 2-3 years, and you don't want to be overcommitted to a higher rate today for 5 years when in 2-3 years it could reset to a lower amount. Do you think that a demand for non-federally regulated lending will soar? It already has been, okay? The stress test and the qualifying criteria today has been very prohibitive for borrowers, okay? You can't borrow as much. The borrowing capacity available to people making 150 grand is like 3.5 times their income. And it's not giving them enough room to go out and buy their home or refinance. So they're moving into the unregulated lending areas of mix and private lenders. You really want to be careful, okay, who you deal with in the private space, okay? Lender fees, broker fees, the rates are excessive. When we deal with our private lenders, we really like to know that they're open terms. There's no back-end fees if you want to get out. We try to do our best to always find open private money, so that way when you have been rehabilitated and you have the ability to get out of the deal, there's no hidden fees. You want to know what all the costs are associated with that transaction from start to finish before you enter into any contract. There have been clients that have approached us and we've told them it's best to sell. I don't want to make any money from you because it's not going to end well. And that, real tough love is not well received most times, okay? And people don't like hearing it. And the reality is we're trying to help our clients. And in some cases, the best way out is to sell and protect the equity in your home for yourself and your family. Don't give it to a private lender. Don't give it to a mortgage broker. Don't give it to a lawyer, a couple lawyers that got to do the legal fees on both ends, which you're responsible for paying for, okay? Protect that equity and save it for you and your family. Take the hit over the head and start over. You're not alone. You're not the first. You're not the last person to be in this situation. And we're really helping people through tough situations with real helpful solutions that sadly aren't always what they want to hear, okay? So please look out for a professional, whether it's myself, Ron Butler. There's a lot of great people out there that are really trying to do their best to help you in a tough situation. And always remember, private mortgages are temporary. I call them bridges and band-aids. They're bridges to get you over to the other side, or they're band-aids to solve a short-term problem. But you have to rehabilitate yourself and get into a better deal at the end of this exercise. Otherwise, going from private to private to private is just a disaster waiting to happen. Can Trudeau slow the immigration until we catch up on housing and infrastructure? I don't know what to tell you. This guy is not the brightest light on the tree, okay? Bringing in immigration at the level he has been doing so, and all the non-permanent residents, with the lack of housing, has created the problem we're in. It is unbelievable to me that the federal government responsible for manpower, immigration, the province responsible for zoning and planning, and the municipalities responsible for permitting of construction cannot be aligned 5-10 years into the future about what is coming on the immigration front. Setting an immigration target for 2024, 2023, a year before doesn't give the provinces or the municipalities enough time to build homes. It just doesn't. So it just behooves me on what's going on. Like, it is a fucking mess. And it's only going to get worse. The standard of living for Canadians has dropped the last decade. Okay? It's dropped to a level that I don't think we're going to have to go through a generation. Every year we're in a worse situation than the year before. And it has to do with inflation, the cost of living, and the standard of living. It's just a disaster. Last thing before I leave, I want to talk about the Porsche used car tracker. As you folks know, I have weekly been tracking the number of used Porsches for sale. And I use the Auto Trader website and go on there and track how many used Porsches are for sale within a 100-kilometer radius of where I sit at Dufferin Norfolk, just south of Yorkdale, off the 401. And last week we hit a high. Last week we hit 1,264. I don't think I've ever seen that many used Porsches for sale. And this week, slightly less at 1,253. So there was 11 used Porsches net, 11 sold in the last week. So somebody's gotten a pretty good deal. And we're still seeing an elevated level of luxury cars for sales. As the market starts turning and people have less disposable income, people are going to get rid of their toys. So on that note, I want to thank you all for joining me on this episode. And I encourage you, be kind. There are a lot of people struggling out there. A lot of folks are hurting. If you have the resources and the capability to buy somebody dinner, buy somebody a lunch, a coffee, a drink, whatever, do so. You may be putting a smile on their face that you don't even know what impact it does, positive impact it has. So please do that. And until next time, we'll see you. Enjoy the weather and have a great weekend.